One big voice from the NBFC space to another. We have Dinanath Dubhashi, who's joining us from L&T Finance Holdings to talk about how earnings have fared for them. Great to have you, Dinanath, on the show. Let me start off. What has led to the gross NPA and provisioning cover to be stable this quarter?
So gross stage 3 has reduced from 7,500 crores last year and 6,119 crores last quarter to 6,033 crores. So there has actually been a decline in gross stage 3. Net stage 3 is down actually from 2,222 crores last year to 3,222 to 2,263. In percentage terms, the gross stage 3 is down from 10.4 to 6.74 year on year, and last quarter it was 7.1, so it has reduced to 6.74. Net stage 3 is down from 4.74 to 2.64. PCR, provision cover, has actually increased from 57% last year to 62.5% this year, and sequentially it was about the same, 62.5. So we have shown this continuous improvement in gross stage 3, not only over last year but also over this quarter. The provision coverages have been strong, and which has led to a reduction in net stage 3 as well.
How much exposure to IL&FS and provisions have been made so far, and how much more will you need to provide for in the coming quarters?
15th of October, NCLAT passed a moratorium order. Our interpretation of that, supported by legal opinion, from a former Chief Justice of India, no less, it says that this moratorium applies to only precipitative actions by lenders like prepayments, foreclosures, legal actions, and it doesn't cover normal repayments. And our view is confirmed by the fact that by the end of the last quarter, there is all repayments. Everything is absolutely current and on time. Okay. There seems to be some interpretation recently taken by some SPVs that it also applies to normal repayments. I can state quite happily that today is 21st. Within 7 days, on 28th, there is a NCLAT hearing, and we expect clarity to emerge, and clarity is good for everybody. Clarity to emerge from that hearing. So that is the first issue, moratorium. Second issue of loss given default. Let us take the worst case scenario. We believe that the normal repayments will not be affected, but let's say the worst case scenario, that there is a few days moratorium, and moratorium means moratorium, it's not permission to default, right? A moratorium is given even on normal repayments. It is important to see the cash flows, the valuations of these projects. Looking at all the project factors, we believe that each of these projects is actually solvent and equity positive, and there is no question of the senior secured creditors that we are in of taking any haircut. So the loss given default on each one of our exposure, which is current at the moment, is zero, the loss given default, and hence under Ind AS there is no need for taking any provisions.
Do you see resolution of IL&FS SPVs, and if so, then which assets will you need to take a haircut?
So, very simple. If I believed that I need to take a haircut for any asset, we would have taken the provision. So, very clearly. So, just to give you some facts, so we have 6 projects. IL&FS has recently asked for expression of interest for sale of 5 of those assets, and the 6th, actually the concession period is ending in 1 year. So there is no need to sell that. That repayment is coming normally. So 5 of the 6 assets, there is already expression of interest being asked for from IL&FS, and as the process goes ahead, we believe that those projects will be sold. Our calculations show that each of those projects, there is a decent equity value. Forget there is no question of any haircut to be taken. We believe that debt, and especially secured debt holders, will be paid in full, and on top of that there will be some equity value also, which will be good for IL&FS and the lenders to IL&FS, the parent company.
Now, do you see margins on quarter basis due to your borrowing cost, and how will your borrowing change and pricing change going forward?
So if you would see the borrowing cost, actually we had predicted that from Q2 to Q3 it will go up by around 20-25 basis points. We have been able to maintain the increase at just about 17 basis points. If I have to give a guidance, there are two factors. Bank borrowings rates have gone up, but at the same time CP rates have come down. So generally speaking, Q4 guidance, we believe that the increase in Q4 over Q3 cost will be 0 to 5 basis points. So largely Q4 should remain at the type of Q3. Now, the way we have managed Q3 is very strategically. We have not starved our core businesses of retail, that is rural and housing, of any money. For the real estate and core infra, we have been selective, and other opportunistic businesses like DCM or structured finance, we have not allotted any money. Because of this, the portfolio change, one, and second, increases taken in our rates to our customers and the increase passed on, you would notice that NIMs have remained quite steady at 5.01% between Q2 and Q3, and we don't expect any deterioration in NIM in Q4 as well.
Okay, the total AUM growth that you see for 2019, are you expecting any kind of slowdown there?
So as you would see, 2019, the first 6 months our growth was around 24%. In Q3 our growth is around 22%, which indicates how we have managed our liquidity and we have kept our opportunistic businesses down. Largely I think Q4 growth, that is overall year's growth, should remain around this level, 22 to 23%, right? Going ahead, I wouldn't like to make any short-term predictions because it's an enigmatic year, it's an election year. You don't know, sometimes election years can be very good also, but it is too early to take that prediction. To give a 3 to 5 year guidance, AUM growth of 18 to 20% CAGR should be well within possibilities.
Okay, so let's get numbers there. What is the growth and targeted return ratios for 2020, and how is it that you plan to achieve better return ratios?
Our return ratios, as I said, if you mean ROE, our targeted ROE is always in the top quartile, which we have maintained for the last 3 quarters, and that would be our endeavor to maintain that. How we will do it is absolutely through the basics of business, that is growing our good core businesses, one, maintaining NIMs plus fees, not only NIMs but also earning lots of fees by cross-selling, etc. And you would note that our fees itself actually pay for our entire operating expenses, and that's a very good virtuous cycle where a NBFC can get into. The third thing is maintaining operating expenses at a good moderate level, and last but not the least, what makes a good and sustainable company is continuously reducing gross stage 3, that is improving asset quality and low credit costs. So it is actually just basics of businesses which will help us maintain this.
Okay, and Dinanath, impact of RBI relaxed norms on SME segments, what has that been for you, if you could quantify that, and can you give us more insight into how that exposure would be maintained for the future?
Specifically for us, right now, it doesn't affect us because our SME portfolio is next to nil. So it doesn't affect us. In these numbers, there is no either good or bad effect of the relaxation. It is zero. But we see SME as a good emerging sector as we go ahead. As we plan for our future, we will look at whether this sector should form a part of our future plans. But clearly for this quarter, there is nil effect.
Thanks very much for joining us, Dinanath, with those details about your earnings, and wish you the very best for the future.